Lately, there have been a lot of articles popping up here and there talking about how people are investing a lot into options. Options can be a little bit confusing when you just start to look into it because there's a lot of different types of lingo that are kind of encompassed within it. So in this video, we're going to go over options, how do they work, and just get over the basics for them. By the end of this video, you'll understand how options work, and you'll have a good idea of how they differ from stocks, and maybe you'll prefer investing in options instead of just general stocks. Let's get into it. An option is essentially the right to buy, not the requirement to buy, the right to buy, some kind of security, usually a stock, at an agreed upon price at some point in the future. This is essentially a bet between two investors, the seller and the buyer of the option. The option buyer pays the option writer, or the seller, a premium. In exchange for this premium, the option buyer gets the right to then buy or sell whatever the agreed upon stock was at the agreed upon price at some point in the future, back to the seller. Buying a share from the option writer is what's known as a call, whereas selling a share to the option writer is known as a put. The whole point of a call option is that you hope that the stock price increases, whereas with a put option, you hope that the stock price decreases. One thing you should note is that if you're buying an option, it's generally a contract for 100 shares. That means whatever the premium is, you're paying it per share. So if the premium for a contract is $1, it means you'll likely be paying $100. So why buy an option over a stock? Well, the returns are actually really different. So let's say you bought the stock SAMI for $50. Now, if the stock goes up to $55, you've gained $5 in your portfolio. Whereas if the stock goes down to $45, you've effectively lost $5 in your portfolio. So let's say instead you buy a call option for the SAMI stock. You pay a $1 premium on 100 shares at a strike price of $50. This simply means that you paid $100 in terms of premium for the right to buy up to 100 stocks of SAMI at the price of $50. Now, if the stock price of SAMI goes up to $55, you can now exercise your option and buy up to 100 shares of SAMI stock at $50, meaning you're effectively kind of beating the system there in that you're now buying a $55 stock for only $50, so you're making $5 effectively. Technically, you'll be making $5 profit minus the $1 from the premium. So you'd be making a $4 profit. This is what's known as being in the money. Meaning that you are now making a profit, or you're now eligible to be making a profit because of your call option. It is worth noting that because of the premium, if the SAMI stock went up to $51 and you sold, you would actually be breaking even, because you would essentially be selling for $51, meaning $1 profit, subtracting the $1 premium, meaning you would be left with no profit. Now, let's say that SAMI stock goes below $50 or even just tanks completely. You don't really have anything riding on SAMI stock because you don't own any SAMI stock right now. So really all that you've lost is your premium that you've paid. So this works similarly for a put option. So if you bought a put option with a strike price of $50 for SAMI stock and the SAMI stock price fell down to $40, you could actually sell SAMI stock for $50. If it rises above the $50 limit, then your put option is essentially worthless. One thing to note though is that if you do buy a put option with the strike price of $50 and it goes down to $40 in the market, you could technically buy 100 stocks at $40 and then sell them again at $50. So it's not like you need to actually own the physical stock, or not the physical stock. You don't actually need to own the stock in order to be able to exercise a put option, because you can just buy the stock because it's already less than what you're going to be selling it for. There's also the like option, which is the option for you to go down below and smash that like button for the YouTube algorithm. I know I go on about this a lot in pretty much all my videos, but it really does help out a lot. Thanks. So far we've talked about buying options or the long option, but there's actually the other side of the coin where you can sell options, which are called short options. So in this case, you are the option writer. You're kind of betting on the other side. You're trying to sell an option for a stock that you think is either going to stay still or go a specific way. So you're going to be betting the other way. The goal as the option writer is essentially to sell an option that will not be exercised and ideally will be worthless, because in that case, you just get to collect the premium. So kind of the scary part of being an option writer is that while there's a very simple upside, the upside is pretty fixed because it's just the premium, whereas the downside can be much, much larger. So say you were an option writer and you were selling short calls for the SAMI stock with a premium of $1 per share and a strike price of $50. Now, say SAMI stock is currently at $50, so you're just hoping that it stays at that or it goes lower. So far as the option writer, you have gained $100 of premium. Now, what happens if SAMI stock skyrockets from $50 all the way up to $400? Well, that means that the option, the call option you have sold, the person can then exercise that call option and buy up to 100 shares of SAMI stock at $50, even though SAMI stock is now all the way up at $400. What that means for you as the option writer is that you then need to provide 100 SAMI stock to the buyer. But the issue is, if you don't have the SAMI stock, you then need to buy 100 shares of SAMI stock at $400 and then give them to the other person, buying them at $50. One way to kind of get around this is that if you're going to be selling the option, the call option, you can essentially buy or already own the stock that you're then kind of betting against. This is what's called a covered call. This means that if the stock does go up a lot, in the case of our SAMI stock, and it goes up by 8 times, then you already have the stock, so you don't actually have to go and shell out the $400 per stock for the person who's paying only $50, because you already have the stock and you already bought the stock at $50. So the worst case scenario here is that somebody does exercise the option and you can just give them the stock you already own, whereas if they don't, you just get to keep the stock and you get to keep the premium. So comparing them to stocks, you can just buy a stock, whereas for an option, you need to do a lot more research and know at what point it will actually be profitable to exercise your option or just not and lose the premium that you paid. Now, this is just the tip of the iceberg when it comes to options. But so far, what are your thoughts on options? Do you think that they seem like too much of a hassle, or do you like the insurance that they provide? Let me know in a comment down below. If you enjoyed this video, please subscribe. It's free, and you can always change your mind later. Anyways, I'll see you next Wednesday. Cheers.